welcome to the India Pitch. We're coming to you from Hong Kong and we're in conversation with Rahul Chadha. Rahul, appreciate you joining us here on CNBC TV 18. Let me start by asking you, forget China for just a moment, though it's hard to ignore China at this point in time. But the strength of India, the strength of Indian equities at this point in time, what is the sense that you're getting? Because the finance minister is here on this massive outreach, trying to get capital, and that's what every government across the world is doing. As in times of turbulence, the effort really is to try and draw in as much capital as you possibly can. What is the sense that you get about India today?
No, clearly India stands out. I mean, if you look at our funds, India is a big overweight for us, and we believe that India is the best equity stories. But like we've said before, in a period of dollar strength where all EM economies are just becoming a basket case, I think the onus is up to Indian leadership to do the necessary reforms. See, we can't say just because we are India, money's going to come to us.
Yeah.
Because people watch, like in Hawk, on what are the steps we are doing. So, to be fair to the leadership in India, we've seen good momentum in roads, in defense, in railways. But that's not all. I mean...
So the point is that you may not necessarily have changed your view on India, but because of the rebalancing that's happening as far as the larger emerging market basket is concerned, you will need to sell India as well.
Yeah, tomorrow if I get redemptions, India is an overweight for us. So we cannot say that we will not sell India and hold on to everything. So which is where the sell-off is happening. And at the same time, market is not cheap. See, again, you look at consumer staple names, they are 1 year forward.
Even after the correction that we've seen?
They're 35 times. 35 times when growth recovery is going to disappoint because the pricing power is going to be very limited with these companies. So I think what you like in the market is not cheap. Private sector banks are something where you'll find, again, this opportunity. But there, again, things are contingent on...
Valuations continue to be an issue there?
Much more than valuations, it's really a concern of NPS. What you're going to see
on the private sector side as well?
Some of the private sector banks, you have the exposure they have to the steel companies. Forget about the public sector banks. I mean, some of these private sector banks have exposure to the resource sectors where they've got exposure to steel, aluminium companies, and that's a significant exposure. So I think a lot needs to be done. We can't do much about these steel exposures, but what we can take care from a policy making perspective is the exposure to the SEBs, so that at least the power plants are not stranded with...
But are you feeling more enthused, at least as far as the larger power story is concerned? One, of course, is the SEB piece where the government has said that they are going to, and the finance minister confirming that yesterday in my interview, saying that they are going to provide states with a little more fiscal room. So it won't be a plain vanilla extension of the current financial restructuring package, but some sort of extension or some sort of plan is being worked out between state governments, the central government as well as the Reserve Bank of India. Does that give you some comfort as far as the larger power story is concerned and its correlation then to banking NPAs and so on and so forth?
No, the recent sound has been positive. I mean, making the SEB debt as a part of a state's kind of an overall debt so that the cost of borrowing goes down and states are also a lot more prudent about it is positive. But then again, we need to see states attack the root cause of the problem, which is
tariff.
Which is tariff and which is distribution losses. So you need more of these private sectors to take care of the distribution franchise. See, the problem with us is for 10 years we've not done anything and all these problems have come at the same time. So we cannot say that we've sorted a couple of issues and the rest will take our own sweet time because this is a backlog of last 10-15 years. So we've got to sort it now, else you don't know which hole...
Time is not on our side.
See, there were plenty of holes in the boat when the new government took over about 2 years back. We've got to plug each one of them quickly.
How many have been plugged today? I mean, do you believe that at least it gives you comfort that enough has been done in terms of plugging the loopholes?
Okay. So it's really, as we talk to people who watch whatever is happening in New Delhi clearly, the key point is the corruption at the highest levels reduced considerably. Everybody's working together to find solutions to problem. We plugged some of the holes, which was, again, the absence of coal, roads, railways and extent, but a lot requires to be done. So I think that's what we are coming to. And then again, what's happening is, unlike 2000s, let's say 2004 to 2008, where we had a tailwind of a global growth uplift, here this is going to be a struggle. It's going to be a struggle. You'll have pain coming from export sectors. You look around, you've got currencies which have behaved like mid-cap stocks. Malaysian ringgit, Russian ruble, Brazilian real, everything is down 30 to 40% last 12 months. And suddenly those guys have become productive from a currency, or those guys have become competitive from a currency perspective. So if we want to keep our competitiveness alive, keeping our currency stable, let's say a 3 to 4% depreciation, I presume, is going to happen with the
from these levels?
Even with these levels, what we've got to focus on is productivity, which is why a lot of these things need to get handled quickly. Else what you'll see is, without us realizing, some hole coming from here and there in that boat.
You know, you spoke about currencies and how currencies are behaving like mid-caps. So let me ask you about the scenario as far as mid-caps in India is concerned. You know, the correction has hit pretty much everybody and everything. It's been a secular correction that we've seen. Do you see a significant downside from the current levels, or do you believe that we are likely to, at least in the short term, stabilize at these levels?
I think in India, the issue has been growth recovery, which is where one was reluctant to pay top dollar for again, even for a structural growth story like India. And what happens is these pullback gives you opportunities to come into good secular stories. Some of these mid-caps were clearly frivolous. You had issues of liquidity with these mid-caps, and you knew with this kind of business model, would you pay them 25 times? No. These mid-caps need to trade at a discount to the large caps because the growth recovery in the economy is going to be slow. The challenges are going to be a lot more. And as people wake up to this, wake up to the fact that there is nothing such a honeymoon period, you've got to deliver the numbers. I think you'll see market getting a lot more discreet about rewarding the stocks which give necessary performance.
So just pure at an index level, where do you really see the market at the end of this year? I mean, we've seen pretty much everybody revising downwards their index targets for the end of the year. Where do you see the markets at the end of this year?
I think if we look at this, it's always it's always tough to put a number to the index because there's so many moving parts. There are commodities which are going to obviously pull down the index because of poor earnings, but at the same time India does well when you have a bit of a currency depreciation because there are plenty of exporters, IT companies in the index which get an earnings upgrade. I think the key thing for an index is how do private sector banks behave, and that's largely contingent on how much comfort market has on these restructurings in coming quarters on the NPA accretion. So as market gets comfort that we are heading in the right direction on these restructurings, I think there's money to be made in private sector banks.
Okay, are you looking at PSU banks at all?
Not really at this point of time. I think we're seeing government do a bit of it, but I think we've got, and this is something I've maintained for last 4 quarters, we've got to do a lot of work on public sector banks before they become attractive.
Okay, so money to be made in private sector banks. Where else do you see value today?
I think something like autos, where the leading car makers done well in terms of market share gains. We've got a huge under-penetration story for an economy which is 1/5 of China. Our passenger car market is 1/10 that of China. So that is attractive.
Across the board, commercial vehicles as well as two-wheeler manufacturers, or would you stick with just passenger cars? Because sales have actually, for two-wheelers, have been struggling. CVs now on an uptick.
I think passenger cars largely. And then outside that, we continue to like pharma, though the valuations are not cheap at this point of time. So you'll probably look at these names aggressively, 10% lower. Industrial names very selectively. That would happen. And then
infrastructure, are you looking at that side?
Yeah, infrastructure is interesting. Like I think we should see momentum pick up in coming quarters. We've already seen signs of government expenditure pick up from July onwards, and that should play out in again higher cement volume growth numbers and all these things. So infrastructure looks interesting. Telecom looks interesting. Some of these existing telecom names have been beaten down on fears of Reliance Jio launching, and I think data story is for real. And we've played that in China. We've seen a big exponential growth post the launch of 4G in data. The data ARPUs are much better in 4G. So some of these things would be attractive. Consumer staples is something we've been underweight. These names are 35 times earnings. I think volume growth.
Is it just a valuation issue there, or you're actually worried about the fact that consumption continues to be, is not looking really as if it's picking up?
It's a mix of both. See, had these names been 20, 25 times, you would have been happy with the fact, or you would have accepted the fact that the growth response is slower than what you thought in first place. But at 35 times 1 year forward, when the growth is going to disappoint, the volume growth is going to be mid to high single digits. I think more likely mid-single digits with limited ability to increase prices. I think these names would disappoint on the earnings growth. So consumer staples remain underweight for us. IT may be interesting. I mean, more so coming from the fact that our view is most EM currencies would move towards a bit of a depreciating bias. And India, despite being the best of the lot, would have a 3 to 4% depreciation.
But what is your view as far as margins are concerned, specifically for the IT sector? Because now the consensus seems to be that, the sort of 30% kind of margins, those days are over now. So let's contend with, or let's review the kind of margins that this sector is going to enjoy in India.
No, I think margins would come down anywhere. The top guys would be anywhere between 25 to 28. The second tier would be somewhere between 18 to 22% range. But much more than that, what happens is these names would show you a volume growth or sales growth of anywhere around 13 to 15%, are trading at 15 times earnings, which is where you have a room for a 10-15% gain. See, we're living in a low growth world, so that's where we look at this. Nobody would have thought this 12 months back, that Indian markets over next 12 months would be flat in dollar terms, and that's what's happened. In fact, they're down to 3%, if I'm not mistaken, in dollar terms over the last 12 months. So I think a 10% dollar return is not a bad number from here for 12 months from now.